Is the Terra Luna stablecoin behind the Bitcoin market crash? Well, you might be asking, what the heck is Terra Luna? What's a stablecoin? And yeah, why did the Bitcoin market crash over the last couple of days? Well, I'm going to break all of that down for you and more. If you're not aware of the Terra Luna stablecoin, then you certainly probably are after the last 24 hours. I'm going to explain how this stablecoin works, how this peg works, of course, why pegs are always meant to be broken, how Bitcoin got involved, what the risk to Bitcoin is, and really what's at stake for your money if you're using those stablecoin, what's at stake for stablecoins even larger, and what does the future hold for Bitcoin. We'll break all of that down and more in this video, so let's go. All right, welcome back. If you're new to this channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you've learned is wrong. And today we are going to take a look at the Terra Luna stablecoin. So we'll look at both of those. We'll look at this peg, this artificial peg, algorithmic peg that they're trying to do, as well as we'll look at how Bitcoin got involved, what the risks are, and even if you're not involved in this, what the risks are for your money, regulations, etc. So let's go ahead and jump in here. If you look at my screen, you can see right here off the bat, like a headline here. Terra Luna crashes 45%. It actually crashed more than that. And it causes massive losses and a risk to the peg. So let me explain what this is for a minute. So we have a couple different things at play here. So the first thing we have is stablecoins. What are stablecoins? Bear with me for a minute if you already know. So a stablecoin means that it's stable to the US dollar. So theoretically, I put $1 in, $1 US. They give me a token back, worth $1 US. It's always worth $1 US for $1 US stablecoin. So it's as stable as the US dollar is. So whatever the dollar's worth, that's what that token is going to be worth. And then the reason why we do that is because now these stablecoins can be traded across the internet, through all the cryptocurrency exchanges. If I want to go in and out of cryptocurrencies quickly, I can use these stablecoins. I can hold these stablecoins myself. Now, the stablecoins should be stable because they're backed with dollars. And that's the key word, should be backed with dollars. And so what does this mean? So theoretically, when I give them $1, they're supposed to hold that dollar in their account. That should mean a full reserve, meaning if they have $10 given to them, they should have $10 in their account. Now, the oldest stablecoin, the most well-known stablecoin is Tether. It's been the longest lasting coin. It's been around the longest. And there's been a lot of people digging a lot of questions that they don't have the backing that they claim they have. There's been a lot of investigation. There's been lawsuits. I'm not going to dig into Tether, but it's found that they have about 70 to 80% of the money they claim they have in reserves. About that. Leave me a message if I have that wrong. I'll take a look at that. But about 70-80%. But what we've found out now is that more and more stable coins have come to the market and they're getting even more and more risky. So instead of holding all of those dollars in their reserve accounts to pay you back if you want them, they're taking those dollars and buying other things, like treasury bonds, for example, or investing those as well. The problem is that if you want that, or if lots of people want to go get that money back, it's not there. Now, this may sound very similar to the banking system. So the banking system should be full reserve. That means if I deposit my paycheck in the bank, that money should be there if I want to get that back out. The problem is the banking system is what's called fractional reserve. So that means they only hold a very small fraction of the people's money in the bank. The problem that this creates is if lots of people want to get their money out of the bank, there's not enough money to go around. This causes runs on the bank. This is exactly what happened in Canada with the trucker protest. As people found out their bank accounts were going to be seized or frozen, they were going to pull their money out of the bank before that happened. This created a run on the banks. Well, this is the exact same thing that can happen with cryptocurrency stablecoins. If they're not fully reserved, if they're fractionally reserved, then it can cause a run on the bank. Now, how fractionally reserved are they? That's a question. Now, when it comes to Terra Luna, they're not just not fractionally reserved, they're not reserved at all. They're instead algorithmically pegged. So instead of pegging it to $1, they use this contraption, which I'm going to explain to you in a way to peg that to the dollar. The problem is that pegs were meant to be broken. Anytime somebody tries to artificially create this peg, then speculators or traders will always go to try to attack it. So let's go back in history real quickly just to break this down for you so I can explain this. And so let's look at this story here from history. So we can see here Black Wednesday. George Soros bet against Britain. So this is how George Soros came onto the world stage. He made $1 billion in a single day. Back in 1992, George Soros became one of the most famous currency traders in the world, thanks to his timely and brave bet against the Bank of England, what became known as Black Wednesday. With a cost of about £3 billion, Britain's central bank was unable to defend itself from an attack in the currency markets. Soros made about $1 billion in profit as a result. Just to break this down real quickly, how this works, so you can understand what happened with Terra Luna. The European Exchange Rate Mechanism, ERM, so this is a mechanism designed to hold that, was set up in 1979. Basically, it set an upper and lower margin of their exchange rates. It was a semi-peg, but what happened is when Britain joined the ERM, the rate was set up at 2.95 Deutschmarks per pound sterling with a 6% move in either direction. The problem was the country's inflation rate was high. So then the currency traders took note of this and said, oh shoot, we can make a lot of money. Let's go after this, and they did. George Soros was one of these bearish currency traders. He amassed a short position of more than 10 billion worth of pounds. So he amassed a short position. So he borrowed against it. He went and attacked that and said, hey, if we pile enough short positions, they won't be able to defend this peg. When the peg breaks, we'll make money, which they did. They made $1 billion. And so this is what happens when someone tries to artificially create the peg. This is what happens with fractional reserve banking. This is what happens with backed currencies or gold-backed currencies, or if someone tried to create a gold-backed cryptocurrency, we could see the same thing. And that's exactly what happened. So let's dig into this a little bit here and take a look at this. Here's an article right here. I'm going to link to it down below, why I'm betting against Terra Luna. This is a very in-depth article that goes into exactly how this whole situation works. I'm not going to read the whole thing to you. It is super complicated. I'll link to it down below so you can check it out if you want to. What I'll tell you is that I've read through this many times. I've had many discussions on this trying to figure this out. We've kind of got to figure it out. But you should never be invested into something that you don't understand. And this is very complicated. So let's look at a couple things. So first of all, it's fragile. So think about this. You have $1 that goes in and it creates a US dollar stablecoin. The problem is that stablecoin isn't redeemable back for my dollar that I'd want. Instead, it's redeemable for a dollar's worth of a LUNA token. So we need to see what the valuation of how many people put dollars in the US dollar, the UST, US stablecoin Terra Luna, and we need to see how much value is in the LUNA token itself, because that's really what's going to be used to pay us back. Now what happens is, if I want to redeem my dollar, they'll give me the LUNA tokens that are worth about $1. But then I still have the LUNA token that now I have to go sell in the open market. Now what happens when a bunch of tokens or a bunch of money pushes down on something, dumps onto the market, the price goes down. So that's the first part. So let's look at this. At the time of this article, it's not today, we'll look at the numbers in a second, there's 18.5 billion UST, while the market cap of LUNA is 28 billion. So that means there was 1.85 billion of US dollar stablecoin, the Terra Luna stablecoin, but the LUNA token that they'll give us in exchange was 28 billion, so that's good. There's more Terra Luna tokens than there are UST claims against them. However, naively, one could conclude that there should be more than enough USD available for the amount of UST that might want to leave. Well, I mean, there's only 18 million that could leave, or I'm sorry, 18 billion, but there's 28 billion tokens. That's good, right? No. This conclusion would be incorrect. The reason why is the market cap is defined as the market price times the circulating supply. So if the token's worth 25 and there's 4 of them, the market cap is 25 times 4 or 100. All right, but that's the valuation, that's not money in. So one would have to sell the complete circulating supply of a token at the prevailing market price in order to generate proceeds to the tune of the token's market cap. So basically, to give all that money back, you'd have to liquidate the entire supply of those tokens at their current price. The problem is that's not how it works. It's the valuation, not money in. So as we can see here, when selling a large amount of tokens, though, none but the first few of those will obtain the prevailing market price, because the price will quickly crash. For that reason, only a USD amount worth a fraction of a token's market cap can be pulled out to the markets. So what does that mean? The first few tokens go at that prevailing market price, But then as more tokens continue to get sold, that downward selling pressure brings the price of the token down, which then means I have to sell more of them just to get the same amount, which puts even more pressure, which then brings the price down more, which means I have to sell even more of them. And you understand we get into this death spiral. So theoretically, if we had $100 worth of market cap, we might only get out $25, maybe only $15. We don't really know. It's an experiment. At the end of the day, depends on how many people want to leave at that point. If we continue on, I mean, basically this is a Ponzi scheme. So what happens? Is as more people put their dollars in, the UST balance grows. Also, the Terra Luna tokens balance grows as well. So it's a Ponzi scheme. And then what happened is they use that new money in to pay out interest to new entrants to attract more money in. And they do that with the new money in, like a Ponzi. So we can see what's happened is, and a lot of people may be aware, I've talked about this before. So you put the dollar in the UST, the US Terra Luna stablecoin, and then you can stake it on Anchor Protocol. When you stake it on Anchor Protocol, you're making about 19.5% interest. That's amazing. You mean on a dollar, I can earn 20% interest on a dollar. Many of you might ask, how the heck can they afford to pay that? And that would be a good question to ask. If it typically sounds too good to be true, then you know what the answer is. It typically is. So what happens is, how can they afford to pay me 20% interest on a dollar? Well, they do it with new money in. So as we can see, that new money in is paying it back, which of course, as it says here on the screen, is a hallmark of a Ponzi scheme and is not sustainable. Sometime in the future, the inflow of new funds attracted by Terra's exceptional interest rate will no longer be high enough to compensate for outflowing principals and interest. At that point, Terra's resilience to UST supply contractions will be tested. And so, just like a Ponzi scheme levers up really fast, it levers down really fast. If I jump ahead here, now let's look at the screen. We can see here now the depegging scenario. So how does this peg work? It says that the Terra Protocol's market module enables users to always trade 1 USD worth of LUNA for 1 UST. That's the stablecoin, and vice versa. This statement in particular, the word always, is false, however. In reality, the Terra Protocol offers less and less USD worth of LUNA for 1 UST, the more UST per minute are traded. So what does this mean? As everybody starts rushing for the exit, if we're in a movie theater and somebody yells fire, well, everybody's going to panic and run for the exits. The problem is there's probably only 2 exits. So how many people can flood out of those exits? And that's exactly what happens. So the more people that are rushing out, they'll throttle that exchange rate. So you can see here on the screen, if there's 450,000 UST per minute being traded, you'll get a 95 cents to a dollar. So for every dollar of UST you have, you'll get 95 cents back if there's 450 traded per minute. But if it goes up to 7 million per minute, you're only going to get 50 cents on the dollar. This provision throttles the arbitrage process. So they put this artificial throttle on there to prevent these types of runs. So you can see this algorithmic stablecoin is very complex. There's lots of moving parts that could break. Now let's take a look at some of the details and some of the data here. So what we can see here is Terra Analytics, and you can see here the circulating supply changes. And here, let's take a look at this one. So this is the daily change in LUNA total supply, excluding community spend. So what we can see is that as more people are taking their dollars out, it's creating more LUNA token. You can see actually these 2 charts over here on the right are inversely correlated. So right here is the daily change in LUNA circulation. So you can see it's stable, 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 and then boom, look at the amount of LUNA that's been created at the same time as the dollars are being taken out. Now, unless you've been living under a rock, you realize the entire stock market is completely melting down. We had a bloody Monday yesterday. Gold stocks were down, precious metals, commodities were down, the stock indexes were down, Bitcoin's down, everything's down. That creates a liquidity event. That means everybody's afraid and everybody's looking for liquidity. They're trying to sell anything they can. And so a lot of people that had these US dollar stablecoins that were making this 20% interest, they did that to keep that money liquid, meaning they could cash it whenever they wanted. So they said, oh shoot, I need that money. Oh shoot, I see that peg is breaking. Oh shoot, there's a chance I might not get my dollar back. I better sell it now. I don't care if I only get 75 cents. I just want my 75 cents back. And so as you can see on this chart, as these dollars are leaving the system, it's increasing the amount of Terra Luna tokens. Now, the problem is again, the market cap is the price of a token times the circulating supply. So if you increase the supply, what happens? Well, that market cap now gets divided by all the new tokens, which brings the price of the token down. You can see how fast this has happened. Over here on this chart here, UST, this is the total supply of UST, and you can see how the amount of dollars, the USD, the token, the stablecoin, has been plummeting. Again, you can see it in the red right here, which then, as I said, creates this inverse supply of Terra Luna tokens being created, as you can see here on this chart on the left as well. Now, the scary thing is that what's happened is the founder of Terra Luna, Do Kwon, decided that it'd be a good idea to take all these UST, all these dollars that he's collected, and go buy Bitcoin with them, and go buy some other cryptocurrencies with them. He did this to somewhat back it. So just in case, because all these people that own this dollar stablecoin are supposed to be able to redeem it for $1 or $1's worth of other tokens. But if the Luna token continues to drop, it might be very difficult to give them back everything they need. So he went and bought Bitcoin to back that, to peg that. And so if the Luna tokens were enough, he could liquidate the Bitcoin and give that back to him. And again, this is a great idea as long as Bitcoin continues to go up. What happens if Bitcoin goes down? Well, that's an interesting thing, and that's exactly what happened. So what we can see here is this is the Luna Foundation Guard. So this is their reserves. This is what's supposed to guard the protocol. And what we can see is that they got rid of 100% of their Bitcoin. You can see it's at 0. They said they've loaned it out. Either way, it's gone. They don't have it. And so they have 0 reserve balance here. They have a total reserve balance of 200 million USD. And they have a total reserve balance of Terra of 100 million. So that's a total reserve balance of 300 million. It's down 82% from the previous high. So they have 200 million of USD, 100 million of the Terra Luna token, so 300 million. However, 300 million against, as we can see here, this is the stablecoin, it's a 16 billion. So people think they have $16 billion worth of stablecoins or dollars to pull out. However, how much reserves do they have to pay? Well, according to this chart, they have 300 million for 18 billion or 16 billion. What do you think? That scare you? That scare you into if you're holding that token? What we can see here is the price of this token has completely plummeted, where basically people are like, fine, give me 60 cents on the dollar, give me 70 cents on the dollar, I don't care. And that's exactly what's happened. You can see this stablecoin plummeted down here on this chart right here, and it's since come back up. Now, theoretically, if you were to buy here at this dip and you bought it at this, 50, 60, 70 cents on the dollar and rode it back up, theoretically, you could have made a bunch of money. So if it dropped down to 50 cents, the stablecoin, and you put $500 million into it, and then it pumps back up, you could turn that 500 million into $1 billion. Sounds pretty good, right? Unless, how do you get that billion back out without selling it? Like we talked about, as you start selling it, the price of the token start dropping down. The more you sell, the further it drops down. And we can see here is the Terra Luna token. And so you can see the price has just been completely plummeting. This is just over the last 7 days. We can see it was just here a couple of days ago was $85. Here was almost $90 just 5 days ago, $90. And here it is today, only worth $22. So your $90 turned into $22 holding that Terra Luna token. And again, the problem is the more tokens they sell to give you that money back, the lower that continues to drop down. Now, what about the Anchor protocol? So remember, people were buying the US dollar stablecoin, the Terra Luna stablecoin, to stake it on this Anchor protocol and make 19.5%. That's great. I love making 19.5% on my money. I'd love to do that all day, unless the asset that I'm holding drops more than that. And so here's this Anchor protocol. We can see this is the daily chart. So we can see here, about a month and a half ago, it's down 90%. So it's lost 90% of its value in this short period of time. So that's great. I'm making 20% annually on my money. However, the asset I'm holding dropped by 90% in that short period of time, and it continues to just fall even further and further and faster behind. So the whole system is starting to break down. Now, will it stabilize? I don't know. Let's take a look at that. Remember, all pegs are meant to be broken. All traders will always go after the peg, just like George Soros did and just like these are. So was this an attack? Well, it could have been. What we can see here is one of the world's most credit-worthy firms, supposedly, borrowed 100,000 Bitcoin. They shorted into this trap. They shorted this, and then they swapped 25,000 Bitcoin for this US dollar stablecoin. And then they dumped the remainder of spot over the week, which then started pushing the price further and further down. Now, there's a lot of speculation that this is done by Citadel. These are some of the people that were behind the GameStop short, if you can remember that. Of course, I'm sure you do. And so why wouldn't they? Why wouldn't Wall Street do this? This is what they do. They aggressively short stocks like GameStop with thin liquidity. They use the the mainstream news to seed the information that they want, sow those seeds of doubt, and to push that price down. Here's a little bit of a play-by-play of how it worked. So the LUNA UST attack was coordinated and executed. The attacker accumulated $1 billion of this UST token and then borrowed $3 billion in Bitcoin. Then they spread around a little bit of FUD, fear, uncertainty, and doubt, a little bit of news about the peg it's going to break, that it would break, and that bank runs would happen. And then they dumped their 3 billion Bitcoin on the market to trigger a wider panic. And so as they started dumping the token and they started dumping Bitcoin, both of them started coming down, which caused a liquidity crisis, which caused more downward selling, and it created this downward spiral. Like I said, this caused Terra Luna to then liquidate their Bitcoin reserves and dump over $1 billion of Bitcoin into the market. Now remember, the first Bitcoins being sold earn the most, but each additional Bitcoin that gets sold gets worth less and less and less. So we just saw in a down market, in a liquidity crisis, when the entire world is melting down, commodities, precious metals, tech stocks, every index is down, Bitcoin's falling. In that environment, they dumped an extra $1 billion of Bitcoin on the market, which only further brought the price down. Now we can see if we look at the Bitcoin chart on a weekly basis right here, down here in red, you can see 1, 2, 3, 4, 5, 6, 7 weeks of selling pressure against Bitcoin. 7 weeks. So they dumped $1 billion of Bitcoin on the open market in that environment. Now, if we go back, you don't see more than 3 weeks of sustained selling ever. We can go all the way back here. Here's 2017, the famed, blow off top in 2017. We see here's back all the way back here, March 17. We see 3 weeks of selling. If we come forward, we can see right around March of 2020. Oh, here's 4 weeks of selling right here, September 19. This is when the price of Bitcoin was $8,000. Even in March 2020, right here, we see 3 weeks of selling. So we're at a point where Bitcoin is most likely completely oversold. We got $1 billion of extra Bitcoin dumped on the market because of that, and that brought the price even down. So in my opinion, I think it's the Terra Luna stablecoin is at least heavily responsible for bringing the price as far down as it's been. It looks pretty good sitting here. In my point, it looks like it's oversold. As far as my viewpoint on stablecoins, a couple things I'd say. Now the SEC is looking at it. It's another talking point for Senator Elizabeth Warren, everybody's favorite aunt that wants to protect us from the world or something like that. It's her opportunity to jump on this and tell us why crypto is bad, tell us why stablecoins are bad. But I want you to know it's not stablecoins or crypto that's bad, it's fractional reserve. If those stable coins were 100% reserve backed, there would be no such thing as a run on the banks because everybody could get their money out. The run only happens when there's not enough to go around. So it's not the stable coin's fault, and it's not Bitcoin's fault. Unless I got it completely wrong. What do you think? Leave me a comment and let me know what I may be missing if I got it wrong, or do you agree with me? As always, give me a thumbs up on this video if you like it, and if you don't like the video, that's okay. You can give me a thumbs down, but at least leave me a comment and let me know why. And that's what I got for you today, all right? To your success. I'm out.